But let's turn back to the question of valuation. Every business owner wants to know what their business is worth, and how do people figure that out? And there's so, very frequently business owners say, well, my business is worth X, and someone else comes in and says, well, I don't agree with that. So there's that gap there. So could you talk to us about the basics of valuation that business owners need to understand?
Sure, absolutely. I mean, to me, valuation is kind of a very cool thing. We talk about dashboards. We talk about, getting the pulse on our business. And I think, one of the most important things we can do is really understand how our business is fitting. And since valuation is really the ultimate business dashboard, it incorporates every facet of the business, it really makes sense that business owners understand that. So let's talk a little bit about, and there's a lot of different, when you talk about business value, there's a lot of different values. Rob Slee, in his book, Private Capital Markets, talks about, I think, 20 different levels of value. So when you talk about value, you need to get really specific. What are you talking about? And the 3 levels of value I want to talk about today are fair market value. Fair market value is the value that an appraiser would put on your business for legal reasons or for IRS reasons. The value that most of us think about as business owners is investment or strategic value. That's the value that a buyer would write a check for or structure a deal for your company for. And then there's really a third value called dynamic transaction value. When you get involved in a situation where you have a business that's very desired and you have multiple companies bidding for your business, that's really the third level of value. But in terms of how businesses think about it, one of the things to remember is value is something that's analyzed, price is something that's negotiated. And to me, that's a critical distinction. In other words, business owners need to understand you can do all the analysis in the world and come up with something that seems to make sense. But the real acid test, obviously, is what the business is going to sell for in the market. And those are 2 very different things. But the 2 key drivers of business value, and something that owners have a general sense of, I think, is value is the benefit of the business divided by the risk of the business. It's in simple terms, it's very simplistic. But when you get into businesses which are very complicated, trying to apply that becomes complicated. And that's what the world of business valuation is really all about, quantifying those 2 things. And I think the thing that I would encourage business owners to do is start thinking about those things in really quantitative ways. Now, obviously, every CEO is looking at financial statements and looking at revenue, but I think one of the things they tend to downplay or not focus on, or at least not quantify, is the whole area of business risk. And we'll talk a little bit more about that, especially when we get into talking about the software. I think the other, basics of business valuation that owners need to understand is this whole idea of recasting financial statements. When an evaluator takes the financial statements of a business, they don't just start applying all the methodologies and body of knowledge of valuation to the financials the way they stand. They recast them. In other words, they look at them and they turn them into something that really represents the business itself on an ongoing basis. And it's something that I think that business owners can really learn from. In other words, when we look at our businesses, we can learn that sort of technique about business valuation. And I'll give you a really simple example. I mean, they go through every piece of the financial statements and do this, but owner's compensation can have a gigantic impact on value. If you are, the CEO of a company and you're taking a salary of $500,000, but replacing you with somebody in the market would only cost $200,000, really $300,000 more falls to the bottom line. If you're talking about a multiple of 5, you just added $1.5 million of value to the business. So, in looking at financial statements, it's really critical to go through there with evaluator's eye and perspective, because just looking at your business the way it is not the way a evaluator would look at it. And I think that's part of the benefit that people can get by sort of putting on the lenses of a business evaluator to look at it.
Now, hang on a second. I think that's a really important point that you just made, that how the business owner's compensation as just one element can impact the value of a company. An owner may be paying themselves a lot. Their replacement by the buyer would be paid less. That difference drops down to the bottom line, and then you multiply it by the multiplier, and it becomes something significant.